Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, young Mark. Right, no slides or charts this week.
No.
This is your 6-minute soapbox. What's going on in this crazy world?
Well, we're still caught between the geopolitics, the trade politics, sanctions on the one hand, all ostensibly negatives, and on the other hand, incoming data, which for the large part, first of all, actually hasn't provided us with many surprises outside of the Chinese trade data today. And that Chinese trade data, one has to say, you have to put it into context. It's Lunar New Year time, so we had a massive 44% surge in exports back in February, and we get the payback this month. Overall, and with the activity data all coming up next week, i.e. GDP, which people expect to be very, very solid, 1.5% quarter-on-quarter, 6.8 unchanged year-on-year, still indicating. And the global economy is ticking along nicely. And next week, we've got plenty more data in terms of activity, UK, US, and China. But we're in this situation where all the evidence points to the fact that any dip which comes on the back of concerns about US-China trade, concerns about Russia, concerns about Syria, is inevitably bought. It's really quite remarkable that we've had $64 billion worth of US Treasury supply this week. That's in coupons, plus another $135 billion in bills, all lapped up. And then we've got this absolute deluge coming our way in terms of investment grade and sovereign bond debt. You know, to have two jumbo issuers from two countries which are a bit of a compare and contrast, Saudi Arabia and Qatar. Qatar supposedly isolated within the GCC at the moment, and yet it was managing to sell $12 billion of multi-tranche debt. Saudi Arabia again sold $11 billion. The Qatar actually priced tighter than the Saudi Arabia at the 30-year area, plus 205. Saudi Arabia priced at plus 210, so not a lot of difference, but you would have thought actually the Qatar would have come with a bigger risk premium. Risk premia are basically not really being built into financial markets. And some of the easing that we're starting to see very, very gradually in the LIBOR-OIS spread probably tells us that some of the concerns of Q1 are ebbing. The interesting contrast is going to be that we're entering the US bank earnings season. And we have this situation in the US where, you know, the average expectation is sort of for an average increase of about 15% in US earnings. That's pretty much unprecedented and all the more remarkable for the fact that people have been revising up their estimates. But today we kick off with the JP Morgan, the Citi and the Wells Fargo, so three of the big four. And I think here the interesting aspect is, have we pumped up expectations so much that it's better to travel than to arrive? More importantly, from the aspect that actually, despite the likelihood that the earnings are going to be good, helped by net interest margins, helped by higher interest rates in the US, helped by the market volatility. But what we don't know is how the whole tax thing is going to play out. And this actually not only applies to the banking sector, but more broadly. And I think there's an interesting aspect here, actually, that what could actually put a spoke in some of the bank rallies is we don't really know how all these tax reform changes are going to play out in terms of the Fed's stress tests. The Fed, as we know, every year conducts a comprehensive capital analysis and review, so-called stress test, and as a result of that, the banks then have to, as a consequence of that, the banks have to make some revisions to their projected capital needs. It is expected that actually that might be a bit of a negative, and it might actually just roil the rally that we have. So I think the contrast remains between a credit markets or interest rate markets where the appetite is enormous, regardless of currency. Central banks, which with the Fed this week, we've had a very clear message. They don't see anything going to derail things. They are worried about the trade tensions, but they still, very much clearly on a path of 3 perhaps for depending on how things evolve with financial conditions. And markets are still basically overpowered by inflows, and there's not a lot of discrimination going on. And that, to me, puts us in a situation where you do have to worry that there is rather too much complacency out there, particularly, the political risks. I know, we can price in political risks every 5 minutes. Half of them, well, more than half of them never materialize. But one fine day, and I truly hope that it isn't something really horrible, like, a sort of more intense military entanglement somewhere. But one fine day, we are going to upset the apple cart. My concern then is we've got a lot of people who are effectively tourists in asset classes, which they wouldn't be in if we weren't in a low interest rate, heavily QE'd environment. And as we saw earlier in the year with those leveraged trades in some of the volatility indices, ETPs, the consequences when the wheels fall off very gently can be actually quite dramatic.
On that note, Mark, we run out of time. Thank you very much indeed.